Welcome back to the LeverUp AMA series. I'm Marcus. Today we're talking about something that sounds almost old-fashioned next to everything else in DeFi, gold. James is here from the LeverUp team. James, gold's been tradable for thousands of years. Why does it need an on-chain version at all?
It doesn't need one, in the sense that ETFs, futures, and physical bullion all still work fine. What an on-chain version changes is access and friction, not the underlying idea of holding a directional view on gold's price.
Let's start with what it actually is. When someone opens a gold perp, are they buying gold?
No, and that's the first thing worth being precise about. A gold perpetual doesn't represent ownership of physical gold anywhere. It's a derivative contract whose value is referenced to gold's spot price through an oracle feed. Long positions gain when gold's price rises, short positions gain when it falls. No bullion changes hands at any point.
So it's synthetic exposure, not the asset itself.
Right, and the word perpetual matters here too. A traditional gold futures contract has a fixed expiration. You have to roll into a new contract periodically to maintain exposure. A perpetual has no expiry. The position stays open until the trader closes it or it gets liquidated.
Okay, so why would someone choose this over just buying GLD or a gold ETF they already know how to use?
A few structural differences. Market hours is one. GLD and other gold ETFs only trade during exchange hours, and COMEX futures have their own trading windows and margin call cutoffs. A gold perp on-chain is accessible outside those windows too, as long as the underlying chain is operational.
What about leverage? That's usually the first question traders ask.
Getting leveraged exposure to gold through traditional channels typically means opening a futures margin account, meeting a minimum balance, and going through a brokerage relationship. An on-chain gold perp gives leveraged exposure directly from a wallet, with position sizing based on the collateral posted rather than a brokerage's margin requirements.
And the custody side.
That's the third piece. ETFs and futures both route through custodians, clearing houses, and brokerages standing between the trader and the underlying exposure. An on-chain perp settles the position at the protocol layer without requiring gold itself to be held, moved, or insured by a third party.
I want to push on this a bit because it can sound like you're saying on-chain is just strictly better. Is it?
No, and that's worth being direct about. ETFs and futures have decades of regulatory infrastructure, deep institutional liquidity, and physical redemption options that an on-chain synthetic doesn't offer. If someone wants the option to eventually take physical delivery or needs the specific regulatory wrapper an ETF provides, this isn't a replacement for that. What on-chain perps add is continuous access and leverage without the traditional account layer in between. That's the actual trade-off, not a strict upgrade.
Fair. So walk me through how this actually works on LeverUp specifically.
Gold is listed as one of LeverUp's RWA markets, priced through the same Oracle-referenced infrastructure used across every other market on the platform. Positions are settled through LeverUp's protocol-managed virtual liquidity architecture, the VMMV, rather than against an external LP pool. That means opening, sizing, and liquidating a gold position works exactly the same way it does on any other LeverUp market. There's no separate gold-specific mechanism bolted on.
Does collateral flexibility carry over too, or is gold restricted to a specific stablecoin?
It carries over. Gold positions can be opened using LeverUp supported collateral types through AnyCollateral, not just a single stablecoin. So if a trader's already holding MON or LVMON and wants exposure to gold, they don't need to convert into USDC first just because the market happens to be gold instead of a crypto pair.
Why does gold specifically make sense as an entry point? You could have started with any real-world asset.
Gold is familiar and liquid in a way that lowers the bar for a specific kind of trader, someone coming from a traditional finance background who wants to test on-chain execution without first needing a view on crypto-native assets. They already understand what gold is and how it trades. What's new to them is the execution layer, not the asset.
So it's less about gold itself and more about what it represents, the on-ramp for RWA trading generally.
Exactly, gold happens to be the most legible starting point. The broader pattern is tokenized real-world assets moving on-chain, with derivatives infrastructure being built to hedge and trade them. Gold is one market in that shift. LeverUp also lists US equities under the same RWA umbrella for traders who want that kind of exposure instead.
If someone's trading gold on LeverUp for the first time, what should they actually expect day to day?
The same mechanics as any other market here, Oracle-referenced pricing, position sizing based on posted collateral, and standard liquidation logic if the position moves against them. Nothing about gold makes the risk profile gentler. It's still a leveraged position, and leverage cuts both ways regardless of which asset sits underneath it.
James, appreciate the walkthrough. Useful to have the actual mechanics laid out instead of just gold is now on-chain.
Anytime.